You work hard, you pay your bills, you follow the rules, and somehow, at the end of every month, you're barely further ahead than where you started. If that sounds familiar, it's not because you're doing something wrong. It's because the system was never designed for you to win. The financial structures you interact with every single day were built to extract wealth from the many and concentrate it in the hands of the very few. And the most unsettling part is that most people never realize it's happening. Today, through Grand Empire, we're breaking down 10 ways the system is rigged against you. These aren't conspiracy theories. These are documented, data-backed mechanisms that quietly drain your wealth while making the people at the top even richer. Number 1. The credit score trap. Your entire financial life is controlled by a 3-digit number. Whether you rent an apartment, buy a car, get a mortgage, or land certain jobs depends on your credit score. But the credit scoring system wasn't designed to help you. It was designed to help lenders decide how profitable you are to them. Your score only tracks credit card payments and loan history. It completely ignores your rent payments, your utility bills, your subscriptions, and every other responsible payment you make month after month. According to recent data, 150 million Americans have poor or no credit. That's nearly half the adult population being shut out of favorable financial terms, not because they're irresponsible, but because the system doesn't bother counting most of their responsible behavior. A recent survey found that 72% of Americans believe the credit system is unfair, yet 53% depend on credit for basic necessities like food and medicine. The majority know the game is rigged, but they have no choice but to play it. And the punishment is severe. A low credit score means higher interest rates on everything. You can pay tens of thousands of dollars more over a mortgage for the exact same house. The system literally charges you more for being poor. Number 2, overdraft fees, the billion-dollar punishment for being broke. Imagine you have $12 in your account. You buy a coffee for $4. Then an automatic bill of $15 goes through that you forgot about. You're $3 short. Your bank charges you $35. You were short $3, and now you owe $38. In 2024, American banks collected nearly $5 billion in overdraft fees alone. J.P. Morgan Chase led the way with over $1 billion. Wells Fargo was right behind at another billion. The Consumer Financial Protection Bureau found the actual cost to a bank for processing an overdraft is roughly $5. They charge $35. That's a 700% markup on a service you never asked for. Before the pandemic, banks were pulling in over $12 billion a year from overdraft and insufficient funds fees. These fees disproportionately hit the people who can least afford them, those living paycheck to paycheck, the ones who miscalculate by a few dollars. They're the ones generating billions in profit for the largest financial institutions on the planet. That's not a service. That's a wealth extraction machine disguised as bank.
Number 3, the payday loan debt spiral. When you're broke and desperate, traditional banks won't help you, but payday lenders will. They'll give you a few $100s right now. All you have to do is pay it back on your next payday, plus a small fee. Sounds reasonable, until you realize that small fee translates to an annual percentage rate of nearly 400%. In 30 states that allow payday lending, borrowers took out over 20 million loans in a single year, totaling nearly $8.6 billion. The fees alone drained $2.4 billion from low-income borrowers, and the entire business model depends on one thing. You can't pay it back on time. The Consumer Financial Protection Bureau found that 75% of all payday loan fees come from borrowers taking out more than 10 loans per year. It's not a safety net. It's a debt trap designed to keep you borrowing while fees pile up. And these lenders deliberately set up shop in Black and Latino neighborhoods at disproportionate rates, communities that have been systematically excluded from traditional banking. It's not an accident. It's by design. Number 4, the poverty premium. Here's a paradox that would be funny if it weren't devastating. In America, The less money you have, the more everything costs. Low-income households pay an average of 7.1% of their income in financial service fees alone. That's roughly $1,750 a year just to access their own money. Wealthy households pay about 0.2%, around $400. If you don't have a bank account, and 5.6 million American households don't, cashing your paycheck costs 1 to 5% of its value. That adds up to over $1,000 a year, gone, just to convert your earnings into usable cash. Car insurance is higher in low-income zip codes. Mobile phone plans cost more without an upfront device purchase. Groceries cost more in food deserts, where the only options are overpriced convenience stores. The financial system charges a premium for poverty. The less you have, the more they take. Number 5. Inflation, the invisible tax nobody voted for. Every year, the money in your pocket buys a little less than it did the year before. Inflation is often described as a natural part of the economy, but it's a deliberate policy tool that functions as a hidden tax on everyone who holds cash. If you're wealthy, your money is in assets, stocks, real estate, businesses. When inflation rises, asset prices tend to rise too. Your wealth is protected. But if you're middle class or poor, your wealth is in cash, your savings account, your paycheck, and those lose purchasing power every single day. Food prices rose 3.1% in 2025. Healthcare costs climbed 2 to 3% annually. Childcare hit over $13,000 a year. The average new vehicle cost $50,800 with monthly payments of $745. Meanwhile, the average savings account earns 0.5%, while inflation runs at 3 to 4. Every day you keep money in a savings account, you're getting poorer. You just don't notice because the number on the screen stays the same.
Number 6. The retirement illusion. You've been told to contribute to your 401k, invest consistently, and retire at 65. It's the cornerstone of the American financial plan, and for most people, it's a fantasy. A study by the National Institute on Retirement Security found the median American worker has just $955 saved for retirement. Not $95,000, $955. Even among those who do have savings, the median balance is only $40,000. Financial advisors recommend having 8 to 10 times your annual income by retirement. Workers aged 55 to 64 have accumulated just 19% of their target. And 56 million American workers don't even have access to an employer-sponsored retirement plan. No 401k, no pension, nothing. The system shifted from pensions, where companies guaranteed your retirement, to 401k plans, where all the risk was transferred to you. Companies saved billions. Workers got a system they were never taught to manage. And 1 in 5 Americans believes Social Security alone will cover retirement, when it actually replaces roughly half of the average worker's income. Number 7. Medical debt, the silent financial killer. In most developed nations, getting sick doesn't bankrupt you. In America, it's one of the leading causes of financial ruin. Studies show 66.5% of people who file for bankruptcy cite medical bills as the primary cause. That's roughly 550,000 bankruptcies per year. 14 million Americans owe more than $1,000 in medical debt. Even with insurance, most plans cover only 80%. That remaining 20% of a major surgery can be tens of thousands. Hospital costs rise 3% annually. Prescriptions rise 3.4%. A single medical event, a car accident, a cancer diagnosis, can wipe out years of savings overnight. No other wealthy nation forces its citizens to choose between health and financial survival. Number 8. Financial illiteracy by design. If the financial system is so important to your life, why did nobody teach you how it works? The average American correctly answers only 49% of basic financial literacy questions. That number hasn't improved since 2017. Among Gen Z, it drops to 38%. Meanwhile, 82% of Americans wish they'd been required to take a personal finance class. 61% say their school never even offered one. This isn't an oversight. A financially illiterate population is easier to sell to. People who don't understand compound interest sign up for credit cards with 24% rates. People who don't understand amortization think they're getting a deal on a 30-year mortgage. Financial literacy correlates directly with outcomes. Those with low literacy are twice as likely to be trapped in debt and 3 times more likely to be financially fragile. We teach trigonometry in high school, but not how to read a mortgage contract. That's not a coincidence.
Number 9. The wealth concentration machine. All of these mechanisms don't just take money from you, they funnel it upward. As of 2025, the top 1% of American households owns 31.7% of all wealth. That's the highest share since the Federal Reserve began tracking in 1989. The top 1% holds roughly $55 trillion, approximately equal to what the entire bottom 90% holds combined. Since 2020, the wealthiest 0.1% have nearly doubled their wealth to over $23 trillion. The bottom 50% of Americans owns just 2.5% of the nation's total wealth. The top 10% of earners now account for nearly half of all consumer spending. Tax codes reward capital gains over wages. Financial products extract fees from the poor. An education system teaches compliance but not financial independence. Every mechanism we've discussed today feeds into this one outcome: wealth flows upward. Number 10. The debt cycle that never ends. Americans carry over $17 trillion in household debt. Credit card debt alone exceeds $1.1 trillion. Student loan debt sits at $1.7 trillion. Auto loans surpass $1.6 trillion. From the moment you turn 18, you're pushed into debt. Student loans to get a degree, a car loan to get to work, a credit card to build the very score that measures how good you are at carrying debt. Then a mortgage, the largest debt most people ever take on. Each debt generates interest. That interest generates profit for the lender. Monthly payments tie you to your job. The need for a steady paycheck keeps you from taking risks, and the inability to take risks keeps you from building wealth. The absence of wealth keeps you dependent on more debt. A closed loop working exactly as designed. Those are 10 ways the system is rigged against you. 10 mechanisms that quietly, legally, and systemically transfer wealth from ordinary people to the institutions and individuals at the top. But here's the thing about understanding how the game works. Once you see it, you can't unsee it. You can learn how credit actually works and use it, instead of being victimized by it. You can avoid the debt traps designed to catch you. You can invest instead of just save. You can educate yourself in ways the school system never did. The system may be rigged, but knowledge is the one advantage they can't take from you. Through Grand Empire, we'll keep exposing the financial structures they'd rather you didn't understand. Subscribe and turn on notifications because there is much more to come. The best way to beat a rigged game isn't to stop playing. It's to learn the rules better than the people who wrote them. Thanks for watching. We'll see you in the next one.